You know, banks, much like the market as a whole, they're down a fair bit. They've kind of held their own against the S&P 500 over the last few months. But the big question is, what has already been priced in terms of a potential recession? What's your top line take on that question?
Mike, it's a good question, and investors are asking that of us all the time. And I would suggest that the bank stocks are pricing in, obviously, an economic slowdown. And the question is possibly even a recession. Now, we do not believe this slowdown is going to be anything compared to what we saw in 08, 09. And the stocks don't reflect that either. But we think it's going to be more like 2001 and 2002, which was a recession, but the banks were very resilient. Most investors are not there yet, though. So they're pricing in something weaker than 2001 and 2, but not as bad as 08, 09 in our view.
I mean, clearly the rate story, which people thought like in January was going to be the whole deal that made banks a good play for a rate hiking cycle, has certainly come through, but it's being offset by, I guess, people anticipating what's going to be happening on the credit side of things. Are we going to get a resolution to that debate, this kind of offsetting forces anytime soon?
Mike, you put your thumb right on the critical issue. That is it. And I think we will get a resolution to that, not this quarter. As you know, earnings will start October 14th with JP Morgan kicking it off. But I think we're going to see over the next 3 to 6 months that be resolved. And we know today credit is very strong for the banks. And I would suggest that the de-risking of the banking system has been very clear since the financial crisis. So this issue on credit, we think, will be resolved as people finally start to realize it won't be anywhere near as bad as 08, 09. And you're right. You look at the net interest revenue growth. We're seeing 25% net interest revenue growth year over year. That's very powerful for the banks.
So given all the cross currents, Gerard, what are your top picks going into this earnings season?
Morgan, what we would do is focus on the regional banks, the right side of the balance sheet, as we like to call it. It's been 15 years since anyone's really had to focus on cheap core deposits. That is going to be the advantage the regional banks have over the larger banks over the next 6 to 12 months in this elevated interest rate environment. These banks also don't have the exposures to the leverage loans or the bridge loans that we might be seeing being hung up over the next 3 months or so as the big money centers do. So the regionals, including names like M&T Bank up in Buffalo, New York, PNC, Fifth Third, KeyCorp, Regions, all very strong core funded banks with very solid commercial loan books, which will benefit from this higher rate environment as well.